Should you be trading covered calls? Well, I know it's a very popular strategy. A lot of people trade like this, and I used to trade a lot of these covered calls. They have the same profile, the same risk profile as a as put selling a put. Okay. So what you would do with selling a covered call, uh, you're basically, let me just take this trade off. That's my trade I have on. I'll go here to this trade here. This is basically what a covered call trade would look like. You'd be going in there to buy 100 shares of stock. You'd go in and buy Apple. In this example, you'd be buying Apple at $130.84. Um, and you would simultaneously sell a call a little bit out of the money. Okay, so in this case, I just put this example down of $132.50. So this is obviously a bullish position. Okay, your break even is down here at about $125. Okay, and you basically want the stock to go higher, obviously. And this green line is the expiration. And in this case, the expiration is in April. And you can see here in this box here, if we advance the stock a little bit higher from that 132.50 on up, your max profit would be $758, which is great. The only problem is when you're trading these covered calls, you could get into trouble very easily. Now we got here, Apple's basically at $131, and our break even is basically down here at about 125. That's a $6 move down, and you're at break even. So if we look at a price chart on Apple, how many times do you see Apple move around and move around a lot more than that $6? So here you're at 138, 137 bucks, 138 bucks, and you bought them here at 104. I mean, that's a move right there. That's 30 bucks. Can you handle a $30 move? What happens if it drops 30 bucks? Okay, you go down 130 to 100 bucks. That's 30 bucks, and you'd be down here, and you'd have a loss about 2,400 bucks. Yes, there are uh, adjustments you can make, which are basically additional trades. If you had to move down like that, you would be the call that you sold wouldn't have the same value, obviously, and you would have a gain on the call that you sold. Um, and then you'd be trying to constantly sell more calls against it to reduce your cost basis. But the problem that you'll run into trading this close and with this much wiggle room, which isn't much at all, you could rip down, and then you're gonna move higher. So from say 104 to 126, say, just as an example. So we were down about 104 bucks, and then we're gonna rip higher to 126 bucks. So what happens if you sold a call down here? You'll have a stock that you'll have a loss on the stock, and you'll be selling an upside call maybe here at 115 bucks, and you'll collect whatever. Yes, you will reduce your cost basis but overall you'll have a loss on that position, and you'll be forced to give up your shares at that price, that at that call price that you sold it at, that strike price. So I I mean, there are times where you may want to make a trade like this. And basically, I would say this sort of trade is more or less for people that have, not just 100 shares. They'll have, maybe 1,000 shares, 5,000 shares, and they want to. They've had the stock for, years, and they want to take some income because they're feeling like not as bullish on the stock. So they'll take in some credit by selling upside calls. Um, you can even sell in the money calls if you wanted to. If you wanted to go down and say Apple's here at 131, and you could sell a 125 call. It's in the money. So if you were assigned and they took your stock at that expiration date, you would have a loss on the stock, but you'd have that gain on the sale of the call. So the difference would be a profit, in this case of $419. And people trade in the money calls as well. You don't just have to trade a little bit out of the money. And you can go to the other extreme. You can go a lot higher. You could be out here at, well, it's not a lot higher. Just say $140, and you could still take in a credit, and you never know if Apple's going to keep riding higher. And that's the issue with covered calls that I see. It's fine. It's a very popular strategy. A lot of people use it. Um, it's I it's not something that I would want to put in my portfolio. I mean, it's definitely an option, but since I don't buy stock anymore, or very rarely do I buy stock, and I just think that selling puts is uh, is a better way to trade. It's just gives you that gives you a big cushion here, and if you were to be assigned the stock, you would be getting it at such a discount to where, you know, it'd be fine. It'd be fine that you got the shares, but I never I never take shares, even if the stock goes way against me. I just rather just kind of roll down and out to as far as I have to in order to collect some sort of credit, or maybe it's a slight credit, or maybe it's a debit, but it'll get me to safety. And but obviously, there's risk with anything, and you don't know if the stock's going to keep dropping, to zero. That's why I like to trade puts on stocks that I want to own, that have been around, and in most cases, and are pretty stable. So that's the problem I see with selling covered calls. Also, obviously, doing the covered calls, as with put selling, same thing. You could miss a huge move higher by capping your upside. So if you own shares and you bought them here at $131, Apple has news, or they have a good earnings report, or something bullish happens to it, and you're at $160, you know, you're selling your shares. You have the obligation to sell these shares, at whatever strike you put, uh, whatever strike you set the trade at. So yeah, you might have Apple run up to 160 bucks, but you know what? Guess what? You got to sell it down here in this example at 125 bucks. You still make a profit, yes, but you would have made a lot more money had you just held on to the shares. So that's a downside. And the other thing is a lot of people will, it's kind of like a trade. It's so popular that it's basically for a newer trader that wants to trade, get into stocks and sell options. Um, it's it could get you into stocks that you wouldn't necessarily want to own, and you're just trading just to trade, and you know that could get you into trouble too, and before you know it, you got a you could be stuck with a bunch of losing stocks. Basically, that's what covered calls does. It just kind of filters out all your good stocks will be called away, and you'll be left with the stocks that either went down or they're not doing so well. So that's the issue I have with covered calls. I mean, it's the same risk profile as selling puts. Don't get me wrong. The capital requirements are greater, I would say. Um, I do trade with a portfolio margin account, but I don't I don't use even I use a tiny fraction of what I can use because I'm just careful. I'm very conservative, and there are only uh, few times during the year where you could really get well, you can get greedy when the market tanks and the volatility spikes, and that's where you're getting all those uh, you know those high premiums on puts. So that's what I save the money for, and um, that's what I save the option buying power for. So that's something that you have to basically work towards is getting a an account that it's risk based, and it gives you more freedom to trade, especially if you're trading SPX, and there's a lot you can do with it with the margin requirements that you have with portfolio margin. But that's besides the point. This video is just about covered calls, and I'm not saying they're bad trades to make. I'm just saying uh, there are definitely risks, and you could find yourself in trouble pretty quickly if you're not trading stocks that you want to own and stocks that could run away from you, and you're stuck with the call that you sold, and it will filter out the stocks that you don't really want to have. I would say you don't want to own because they'll be the whole purpose of selling a covered call is you're hoping for it to go up maybe a little bit. Okay, if you're trading a little bit out of the money, okay, let's say this example here on Apple, you want it, you want Apple to, you just want to collect that premium, and you don't really necessarily want Apple to go to the moon because that's where you'll lose out. And on the flip side, if Apple has a bad report or some bad news comes out, you're tanking, and yes, you have a slight hedge where you did sell that call, and that will reduce your cost basis a little bit. But what happens when you're down here and you sell a call, and then Apple rips back higher, and you're stuck with that call that you sold, and um, so that's how you could lose. And so that's my feeling on that, and that's why I don't own stock. I sell puts, and they're a lot easier to manage. Okay, I hope you have a great night. Thank you.